Welcome to the C-Suite series presented by Channel Check and Noble Capital Markets. Noble's an SEC-registered, FINRA-licensed broker-dealer and the source of the equity research available on Channel Check. Today's interview features Hemisphere Energy, OTC ticker symbol HMENF. Noble Senior Research Analyst Michael Heim interviews Hemisphere President and CEO Don Simmons. Visit channelcheck.com or click the link in the description to access equity research, news, and advanced market data on Hemisphere Energy, all at no cost. And now, here's Michael and Don.
Don, thanks so much for joining us. Before we get started talking a little bit about Hemisphere, I would almost be remiss if we didn't talk about this morning's big announcement that Chevron is buying Hess Petroleum, after we saw an announcement a couple weeks ago of Exxon buying Pioneer. So definitely it looks like M&A activity is picking up in the energy space. How does that affect you, and what are you seeing on the Canadian side?
Well, thanks for having me, Michael. But yeah, it was big news this morning. Great to see. More M&A activity usually breeds more M&A activity. So certainly like to see that. On the Canadian side, we are seeing some as well. It has picked up. We've seen a few deals over the last few weeks. It's not crazy yet. And I think the more we see through the fall and into Q1, I think we'll probably see more activity. From Hemisphere's standpoint, I mean, we see opportunities to look at out there. Certainly companies and assets that have been put up for sale. So we're almost always looking at opportunities to acquire new properties or merge with companies.
Great. Let's dive into Hemisphere right away. You're a Western Canadian oil producer. You're active in the Atlee Buffalo play. Tell us a little bit more about the Atlee Buffalo play and why it might be a little different than some other areas of production.
Yeah, Atlee is quite unique, and it is the Hemisphere story. It is really describes what we do as a team. So Atlee's conventional oil pools, we didn't discover these pools. They were discovered back in the 70s and the 80s. And they were developed with vertical wells. So they took out maybe 3 to 5% of the oil, but they left the rest. So what Hemisphere's done, and the opportunities we look for, is to come in using more modern technology, 3D seismic, horizontal wells, and then we apply an enhanced oil recovery technology or a polymer flood. And it's been really successful in Atlee, and that we're able to recover more of the oil that's in place that we know is there. So it's not highly risky. And the other part is by applying the polymer flood, we get a really low decline rate. And that really helps the company. That free cash flow that we have and the cash flow that we have, we need less of that for sustaining our production. So there's more there for growth opportunities and more there to return capital to shareholders.
This year, you changed things up a little bit. You did a lot of your drilling in the summer. Tell us why you decided to focus your drilling in the summer months.
Yeah, it's summer's really the best time to drill. You get the longest days, the best weather. But really, I mean, what we always want to look for are ways to save money. And when we looked back over the last few years, we had done maybe 2 or 3 different programs through the year, usually smaller programs, and we saw that we definitely were losing some efficiencies, rig moves, etc. So the one way to kind of get past that or see some of these efficiencies was to lump our drill program all at once. And so we tried that this year. It does mean that your production is a bit more lumpy through the year. But we did see those efficiencies, probably close to about $1 million. So significant for a company our size. The other, aspect is, when you talk about summer versus other times of the year, in Canada, you can drill in the winter. Fall's fine. Winter, though, can be quite cold. You can get down to -30, -40. Days are shorter. You got to heat and keep some extra equipment at the rig for additional heat. So there's added cost to that. And then we also have what we call spring breakup. So kind of the end of March to into May. You're not really able to move on some of the highways and roads. So, moving rigs is not possible. So we don't typically drill between that time period.
We're doing this interview at a good time. Oil prices have been very strong even before we start to talk about any Middle East a conflict. As we're recording this, West Texas Intermediate is somewhere in the mid 80s or so. Tell us how that affects your sales.
Well, it certainly has a positive effect where our benchmark is WTI. So that, every dollar it goes up adds to the bottom line. But other things that are important for Hemisphere's bottom line would be the Western Canadian Select discount. So we've seen that range and be quite volatile through 2023, as high as $25 discount to as low as $11 discount. Something that investors should watch for, though, is in 2024, we've got a pretty big catalyst for that. Canada is going to be adding its first pipeline to the coast in decades. It's going to add almost 600,000 barrels a day. And that's going to really significantly drop that discount. Not only are we going to be able to have more egress of our heavy oil, but we're actually going to have the ability to diversify the customers that we could sell it to. So looking for that to be a big catalyst. The last thing for Canadian producers, not just Hemisphere, is our dollar and the exchange rate. It's significant. Today we're trading the Canadian dollar quite weak to the US dollar. So that's a benefit to Canadian producers who have our costs in Canadian, but we get paid based on the US WTI benchmark.
You've always been a low-cost producer, and you're very profitable when oil prices were low. I imagine things are looking very good now that oil prices are up in the 80s.
Yeah, it's these numbers we're seeing are phenomenal. Really because of some of the things we just talked about on the pricing side. But you marry that with $15 OpEx, and in this price environment, we're seeing around $50 netback. So can't complain. Things are great. As an oil company, we don't get to control the price other than potentially adding some hedges here and there, and we do that from time to time. But this is a real sweet spot for Canadian producers for sure.
So you've been reporting free cash flow well above what you're spending in CapEx, and that really puts you in an envious position of having cash to pay for dividends or for share buyback. How do you weigh the benefits of each of those various options?
Yeah, it's a question we get quite often, and it is something we talk about a lot and discuss internally. So, the primary focus of our company is to grow. So we're definitely using free cash flow and cash flow to grow the company, and it is a priority. From there, we also have our quarterly dividend, 2.5 cents a share. And then from there, there's still some free cash flow left over, at least at these pricing. So we do look at the share buyback, and that's more, I would say, opportunistic. We look for and are probably most active on days where oil prices are down. Oil drops $1, $2, $3. We tend to be the larger bidder and buyer of stock on those days. Mostly when someone will panic and sell, they see the price maybe crashing farther, and we'll take advantage of that. The other thing we've talked about and we have now implemented is if we don't have something imminent on an acquisition side and we're sitting on cash, we will look now and then to a special dividend like we announced earlier this fall.
You just mentioned acquisitions, and we started out talking a little bit about the general area. You have done a little bit of acquisitions recently, or what can you tell us about those acquisitions?
Yeah, we have mentioned that. We haven't talked too much about it yet. We're still trying to keep a competitive advantage while we're continuing to pick up land. But we have told shareholders we've spent over $1 million this year buying crown land, so a position on an oil play. And I can say it's typical to what we continue to do. It ticks all the right boxes from a reservoir point of view, from an oil in place point of view. From an oil quality point of view, to bring our expertise that we've learned in Southern Alberta and Atlee, and apply that to this new area. So we have said in one of our news releases that 2024 we're looking to get in and drill some horizontal wells into this play. If we see what we hope and expect to see, then we'll follow that up with a pilot polymer flood. So we're at the point now, we can continue to evaluate it. and model it, but we need to spend some money and see what we've got.
We were fortunate enough to have you out marketing recently. I noticed in your presentation you had a new chart that really compared what your enterprise value is compared to what your reserve value is, and showing that you are really at a bigger discount than most of your peers. Why do you think that is?
So there's a couple things. There's kind of a high level reason, and then I think a more hemisphere thing that we need to talk about. So at the high level, I think the market mostly today seems to be trading on a cash flow multiple, and when you look at that, we're kind of trading middle of the pack. The range in Canada right now, I've seen anything from 2 times to maybe 5.5 times cash flow, and so we're trading in that sort of 3.5 times cash flow multiple. So I think that's really what investors have been focused on in the market up here. So that creates some advantages to companies like Hemisphere that have some pretty significant deep value. And so why does our difference stick out so much from our reserve value? And remembering that a reserve audit is just it's an estimate of your future cash flow at a specific price deck, right? So, with Hemisphere, we've got a low cost asset that we've spent a lot of the money on developing already in the infrastructure. So we've got years ahead of us of cash flow coming out of this asset, but very little sustaining or capital required to put into it. So that there, gives a bit of that mismatch from reserve value to a cash flow multiple. But also, adding on to that, there's two other things, or one main other thing is in Canada, we have to discount, or we should be discounting the future liabilities and decommissioning costs. So when we do that, Hemisphere has very little future decommissioning costs just based on the type of assets we have. So it's a small amount that we have to take out. Some of our peers and our competitors have to discount quite a bit higher values of future decommissioning costs. So again, really leads to take a good look at Hemisphere. We are one of the smaller publicly traded companies, but there's a lot of value in Hemisphere in those future reserves and cash flow.
So you've got a yield of near 7%. That's got to be attractive for income investors. You've got growing production, a big jump in September with some of the summer drilling you're doing, and of course higher energy prices. That's going to create some growth over the near future for growth investors. And we've just talked about how your enterprise value compared to your underlying asset value is very low, which would obviously appeal to value investors. Who do you see as your primary investors, and who would you like to see, what type of investor jumping into the stock?
Yeah, I mean, we're trying to appeal to everyone, and do it all. And we're in a unique situation where we have an asset that does spit out tremendous cash flow and free cash flow at these in this price environment. So let's look at our shareholder base today. So 14-15% is held by insiders and management. So we are aligned with shareholders. About 10% is institutional shareholders today. But we are seeing an increase in the interest from institutional shareholders for the first time in years, which is great. That's a good sign that we're seeing that interest. But the rest of our shareholder base is really that retail shareholder, and they all have a slightly different whether they're value or growth or somewhere combination in between, and depends on their own personal situation. And those are really who we've been targeting over the last number of years as new shareholders, because they have been the people that are interested in small cap and resources. And we've managed to increase our shareholders across both North America and Europe over the last number of years, and we'll continue to target that market.
Well, I know we've only scratched the surface of Hemisphere, but that sounds like a good question to kind of end on. So, Don, I want to thank you for participating in this, and wish you the best of luck going forward.
Thank you very much. Thanks for having me, and we'll see you soon.
NobleCon 19 at Florida Atlantic University. Located at the center of one of South Florida's most vibrant and fastest growing cities, Boca Raton offers an unparalleled cultural, recreational, educational, and business environment, the perfect setting for NobleCon 19. Now in its 19th year, NobleCon 2023 will be our biggest ever. We're inviting more companies, larger companies, and dramatically expanding the investor representation. And with the move to the FAU College of Business Executive Education, all new, state-of-the-art 50,000 square foot facility, NobleCon is the gold standard on the conference circuit. NobleCon 19 at FAU. It's time to invest in knowledge.